back of the PMIs yesterday, which looked good. Are you expecting this Ukraine effect to come in soon?
I think we probably had that from the looks of it in around February, and since then the March and April data have been a bit stronger, so it may well be that the negative impact has already come through, because of course we didn't see the progression of sanctions that might have been expected. So I think yes, the current assessment will continue to rise. What we're looking for, though, as we saw with the ZEW, is what's happening to the expectations component. Are people saying growth is very strong in the first quarter, but actually we're beginning to have some doubts about the second? If we look at French data, again, we had French business confidence out this morning. That's pretty terrible. So although Germany's doing very well, we can't spread that into the rest of the Eurozone.
The other big data point comes out of the US today, the durable goods numbers. Can we expect the Fed to continue tapering on the back of this number?
We hope so. I mean, I think the durable goods we know will be strong because of orders for Boeing aircraft. What we're looking at are capital goods orders, non-defence, ex-air. We think they did fall quite sharply in February. We should get a bounce in March. Anything above 1.5% starts to add to the general meme that, yes, the beginning of the year was affected by bad weather, but actually the recovery got underway during spring. That's going to continue if orders are up, and so again, it keeps the Fed tapering.
In FX, worry about the exchange rate is the order of the day. That seemed to be the case in New Zealand, continues to be the case in Europe. Let's start with New Zealand.
Well, I think central banks everywhere are trying to talk down their currencies, but with the RBNZ clearly having a tightening bias and being the first developed nation bank to tighten policy, there's not much it can do. I think they try to finesse it as best they could. Yes, the next move in rates is upwards, but they're no longer rushing to neutralise policy. They're now telling you it's a bit dependent on where the exchange rate goes. Exactly the same sorts of messages that we've heard from Europe. In New Zealand, they'll stop tightening. In Europe, of course, we have a chance of monetary easing.
We seem to be shying away from 140 on euro dollar though, right?
Yes, I mean, I think it's struggling to make more gains, but I guess that to some degree in the market is this feeling that if it still goes up fairly high, the ECB will actually finally be forced to match up its rhetoric with some open market operations rather than simply the open mouth operations that they've been relying on since February.